Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today we welcome back our friend Matt Dines. Dines is the CIO, Chief Investment Officer of Build. Good to see you, man.
Great to be here. Thanks, Nick.
Well, we always go to Dines when we need a little bit of financial history mixed in with the market practitioner. Dines is a fiduciary, many years in that role. So, and of course, with his handy Bloomberg terminal, he's able to dissect everything going on in global macro. So I want to start with gold because we have a lot of questions around the advance in gold. So I want to ask you, did gold put in a cycle top last week, but then start maybe at the beginning of this run? What is your perspective? And we have some fantastic charts that Dines has sent us in advance. So we'll pull up slide one and go for it.
Yep. So, Nick, as you mentioned, I'm a fixed income PM first. This is different than the last 40 years where, let's say, as a portfolio manager, you could be just following a rush in a bull market for bonds with higher cycle highs, higher cycle lows. You don't have to think about other asset classes, really. You're just tracking, real rates, stuff like that. And you don't have to think broadly in terms of a 2D or 3D picture, right? In this new era, you do, in my opinion, to be a good fixed income manager in dollar terms, you have to be aware of all these other things, which now includes gold, which has been brought back into monetary relevance in the post-1971 monetary order with China's launch of the Shanghai Futures Exchange and the gold contract. And so just for background, since launching in 2014, 2015, opening up, it's opened up to global capital, not just domestic Chinese investors, capital, et cetera. It's become the center of volume. It's the center of gravity globally in the gold trade. And when you're tracking the gold price, everything starts and ends with China and the Chinese investor. So this situation kicked off. The catalyst was China announcing 2014, roughly, that it was no longer in the nation's interest to continue stacking its dollar surpluses from trade. Mirror this with the current account deficits that the U.S. has been running for ages in the post-World War II era, outsourcing dollars and really funneling the lifeblood. Trade is the lifeblood to this offshore dollar system. China's decision in 2014 that it was no longer in its interest to recycle its trade surplus into U.S. Treasury debt was really the catalyst that brought gold back into a monetary center. So China's forcing the issue. To get there, you have to now extend your models, right? Your framework, if you're thinking about fixed income investing, treasuries, which are the straw that stirs the drink in the kind of the global offshore dollar system. If you take everything that happens in that context, right, it'll guide your positioning and ultimately your performance as a fixed income manager. So you probably don't see that many fixed income PMs like me yet fully ramped up on all these things. It takes kind of the Bitcoin age, the Bitcoin layer thesis, plugging this all in to do a good job. But I think gradually it's changing.
Okay, so let me hop in there. We'll give the viewers a tiny bit of history before I pass it back to you. What Dines is speaking about is Bretton Woods Agreement 1944 set the US dollar with an exchange rate versus gold and the rest of global currencies with an exchange rate versus the dollar. Now, that system in 44 didn't actually get kicked off until 1958 or so because there were capital controls in Europe. So the free exchange of these currencies for each other and for dollars wasn't really possible for the first 14 years. But then from 58 to 71, you did have a foreign exchange market start to develop in a way where currencies could be exchanged for dollars, which could be exchanged for gold. You also had a run on US gold during the 1960s, which triggered a 1971 Nixon shock and the closing of the gold window. Since 1971, treasuries became that global reserve asset because in the trade deficit of the US, they export dollars abroad and those dollars get recycled. As Dine said, the word recycling is key here to understand what we're talking about. The recycling went into dollars and not gold. Then, 2014, China introduced their own gold contract and stopped stacking treasuries in the recycling. So basically, the Chinese recycling of dollars into treasuries gave way to investing in gold. So that's the setup. So we have a Bretton Woods 1 from 58 to 71, a Bretton Woods 2 from 71 until potentially now. But what Matt Dines is telling us is that it actually started about 10 years ago. So that's the historical setup. So now you are saying that you have to watch gold in a way that you didn't have to because the dollar recycling that US fixed income depends on is subdued due to this new nature. So do I have that correct? And pick it
Absolutely.
up.
And you have it more correct than anyone. I mean, like than any other framework that's out there. And this is detailed in the Bitcoin Age. You just highlighted some of the best, my favorite chapters in the book.
The loudest voices in crypto, finance, and economics do not understand Bitcoin. Join Parker Lewis and Dhruv Bansal for Bitcoin Not Crypto, a 3-part masterclass that lays out why 21 million is the key breakthrough and how Bitcoin, not blockchains, creates decentralization and why everything else will be built on Bitcoin. Understand why Bitcoin works and why nothing else does. Register now at unchained.com/TBL. That's unchained.com/TBL. Back up your seed phrases in titanium. Stampseed is a DIY titanium seed plate provider. They offer their own hammers, seed plates, and the tools that are required to hammer your seed phrases into titanium. These plates are rust-proof, fireproof, and they stand the test of time. Stampseed is now offering customizable titanium seed plates. Upload your logo or design, and they will laser engrave it on the back. A secure backup that is uniquely yours. Make it personable, make it unforgettable. Stampseed.com.
So now to get into the markets, right? What's happened? And last week, what happened was an informative event on the gold price chart and my perspective. So now to pull up slide 1, what I've posted here is last week's chart, daily candles. I've got global spot markets of gold. The GLD ETF is in the background. It's kind of in a cyan turquoise color. It's hard to see. But the gold market is open in separate windows throughout the trading day between all the money center financial institutions as kind of the sun rolls around the globe, which market is open. And you get to see a signal on where the price action takes place. So the setup, China opens first. They're not the first one open. Day starts, across the international date line. Tokyo goes first, but it's irrelevant in gold. Then it goes to China. China opens. And since 2014, those China hours have been extremely important on driving the price action. They are the cart and the horse, right? Which one's in front? They're both. They have 2 sessions. Specifically, they take kind of a midday lunch break. It's like a couple of hours long, and you got one stack. They open the action. They cross with London, which is your other key center, take a lunch break, and then you go another 3-4 hours so that you have some China overlap with the United States markets as well. All right, that's super important here because I'll go through the price when we hit that key level of $3,500, right on the penny, and what took place from the futures exchange reported metrics downstream of that.
And I just want to tell the audience before you go on that if you are not looking at time of day price action, you're not really analyzing what is going on in the world. And I just say that as someone who's been watching markets for a long time. Time of day, who's doing it, is relevant. So people might say, hey, why would you care about what time of day? Actually, if we look at the last 15 years of market action, the time at which some of these things have taken place, not just in gold, but in rates, equities, and foreign exchange, it is relevant. So that is why Dines is doing this study. It just
100%.
matters. Yeah.
This old mindset, the 40-year secular bull market in U.S. Treasury debt, where you start seeing dominant investment strategies like passive target date funds, where all it is you just rebalance and it's the 60-40 allocation, or move that sliding scale how you wish. That's all that matters. That only works in a price chart like a secular bull market. But Nick, as you were saying, in a market where things are in flux, a major transition, that strategy where you're not looking at price and the downstream fundamentals of technicals, volume, et cetera, to get footing and measure where value is flowing. If you're not looking at that in these type of situations, you're hopeless. I'll just put it bluntly. Okay, so back to last Tuesday. What happened? So Asian market hours open. Remember, Sunday night, I'm referencing the U.S. I sit in the West Coast, but United States market hours, Sunday evening, gold starts going on a tear. It just rips through 3,300, 3,400. And like all other key levels, 3,000, 2,500, these round numbers in this bull run over the last 18 months, which really kicked off after the November 2022 bottom, I would say, where all risk assets, just reprice against the dollar, we get the rollover and we turn. Those key levels just get broken through, like no resistance at all. And just, it's like World War II breaking through the Maginot Line. There is no resistance. At 3,500, though, on Tuesday morning, after we saw that, kind of peak bullish sentiment coming out on Sunday evening, carrying through Monday, the gold bulls were feeling good on X and what we used to call finance Twitter. I don't know what we call it on X now, but the bullishness, the bragging while it leads ahead, it started getting pretty intense. Okay, so what happens before London market hours open? Gold on the Shanghai Futures Exchange hits $3,500, immediately hits resistance and starts selling. What? There's a lot baked into that right there alone. Like 3,500 spot, on the screws means there was quantity axed behind that on the offer, right? So there's a big wall, and someone in massive size found that important. We don't know who it is, like whatever. It's balance sheets, right? So they want to defend that 3,500 level is going to be defended because the big players want that right now. The other key thing, so Shanghai futures are they're mismatched in both currency and weight in terms of the measurement. So why 3,500? It's telling you the offshore dollar is still highly relevant. This death of the dollar, de-dollarization, the funeral, the obituaries that have been written, too early, right? There's a lot going on. But the Shanghai futures, it's priced in CNY, so that mismatch you have on currency translation, it's 1 degree of freedom. It's also different on weight, right? These are LBMA bars that are in the warehouses that these are stored in. I think they're set, Nick, you probably know this better. They're 100 kilos, right? And then the contract itself is for 1,000 grams or a kilogram of gold. It's roughly 32 and a half ounces. Gold is priced on spot markets, still technically from the COMEX, CME futures also in ounces, right? With I think it's 100 multiplier. So there's a mismatch there totally. So it's like highly relevant that we stopped here and hit the brakes based on the Chinese bull market. And China is driving price. I'll get into that on the next charts. We stopped right at 3,500. So that's where resistance is. You immediately see selling, right? Lower highs, lower lows. And then if we go into slide 2, you look at volume. You had a massive volume surge on the Shanghai Futures Exchange, which if you look back in history, it's being driven by what they label as futures firms, which what that means is it's financials, right? It's non-producers, non-commercial, non-economic, it's financial sector. So broker-dealer activity, trading counterpart, et cetera. And so when their volume surges since this exchange launched, you see the futures firms correlate following price cyclical tops, either higher highs in just a given trend, or larger picture cyclical tops, followed by an actual you call it like distribution, retracement, et cetera, longer term. So the fact that the volume spiked, it's 50% more like than the last spike we saw, and volume is trending up and to the right on this as gold is moving towards Shanghai. The action is happening in Shanghai. You're following an up and to the right trend, but this headline on 3,500 just broke through all prior volume measurements for trading activity for the futures firms, which are really driving price. As they get long, that's when the price action really starts to get bullish. But just to put this in context, the top 2 to 3 registered brokers on the Shanghai Futures Exchange add up to all of the volume on the COMEX, right? So it is just head and center is becoming the global center of trade and gold liquidity. This is where it exists. And then the prior, so news events, right, drive these all-time highs historically. Like it'll be based on a macro event, et cetera. So the last one you saw, April, these events are happening so fast, it seems like it's hard to keep track of everything. But the last one in April, I've circled in green on the chart, where we got a volume surge and a higher high, but it wasn't the cyclical top. That came on the Iran attack on Israel with drones right about this time last year, if we even remember that. It's really hard to keep all of these things in your mind because like the big events just keep coming, right? But in this case, the event wasn't a macro event. There was no geopolitical news per se last week on that level, like Russia invading Ukraine, which was another prior volume surge, Israel being attacked by drones, et cetera. It was purely price, right? Which is information in itself that 3,500 was a key level. And if you go to slide 3, what you see on price, if this is a cyclical top, what we need to be watching for is the reported metrics. And there's people way more advanced than me, right? The actual broker dealers, those type of firms operating in Shanghai and the China and Hong Kong in China, their algos are super sharp here. They're not uninformed players. They're not passive, 60-40 type of allocations that you see dominating in the West. They'll tell you what's going on here in their open interest activity and then the long short bias in the futures firms or the financial sector operators on the exchange reported metrics. So
okay, so let me ask you a question before you get into too much the open interest in these big players. I want to bring it back and ask a question. This is for me, but this is also for the audience. You mentioned that Shanghai is becoming the center of the world of the gold trade. But in the same sentence, you're saying that de-dollarization isn't here yet because the price tag $3,500 per ounce, which is a Eurodollar system price, versus the Shanghai price, which is going to be, first of all, using the metric system and the CNY. So explain to people how both of these things are true at the same time, and take any path you want, because I think this is the key area of confusion for many people that actually, myself, I'm using the term de-dollarization to describe some of the things happening around the world. But at the same time, it's not a broad global de-dollarization on a permanent basis. So get into the nuance there of why you say both of these things are true.
Yeah, so that's the perfect question. And I think when people you have to hold multiple ideas in your mind. And I think the most difficult thing for most people to grasp about this very complex situation that we're traveling through in terms of global human history, as well as global financial and monetary history, is that it's not one thing at each specific time. It's the collection of things. And I think this is a language that not many are capable of expressing. And this is why I think what you're doing with Bitcoin Layer is, extremely important and valuable, from offering a descriptive, or at least a model of what's going on. So when I say, these things, and like we're trying to nail Jello to a wall and come up with a framework that maps onto reality and holds some predictive power. And to do that, you have to let go of this idea that things have to be one thing at a time or the other. There's three main players now in the global monetary system that matter. You got the dollar, and the dollar is rapidly becoming separated into the onshore and offshore dollar. You've got gold, and then you've got Bitcoin. And if you go through and listen to market commentary or frameworks, most of them are very difficult. They focus on one of those swim lanes and they stick to it religiously, and that's all they have in their framework to really understand what's going on and what's becoming a key time of like global geopolitical and like sovereign conflict. You have to be able to explain all of those three things and think of them in terms of like I'd use the word eigenstates, right? They're not one thing at all times. It's not a 0 or 1. It's a combination of all three of those things at the same time. I don't know if that's a good description. It makes sense, but you have to take all of these drivers into your monetary framework. And at the end of the day, what's going on is you've got these different, like we use the word multipolar, right? We express it, that idea is very well shaped. You've got an axis in the EU, you've got Russia, you've got China and Southeast Asia, and then you've got US and North America. I guess South America and Africa are just kind of left behind. They don't so much get thought of because they're not as economically relevant. But we separate those spheres, right, in most frameworks. But what we don't do a good job at, collectively, I'm talking like broad, just market commentary strategists, kind of the pool of theses that are out there. They don't connect the dots between those two of money. And so to do that, you have to use all three, gold, Bitcoin, and the dollar as just a fiat ledger money, to explain what's going on. So these transitions don't just happen overnight. You have to see where one of these competitive players in the game will use those tools to their advantage. But ultimately, this is kind of a Game of Thrones type of situation, if you will.
I'm gonna tell people one example. It might be uncomfortable for people to hear, but I'm going to give you an example of what Dines is talking about, that these things cannot exist by themselves, or they can't be analyzed without the other. You hear, not only you hear, we've seen executive orders being signed, regulation being moved toward a stable coin world in which the dollar's global role is extended through the use of stable coins, right? Extended in that the current way in which dollars are used abroad is a Eurodollar system using banks, but a stablecoin system abroad could use U.S. institutions necessarily, right? Especially if they separate the regulation of these types of instruments. Okay, the uncomfortable truth is that stablecoins literally came from the laundering of money out of China via Hong Kong and Tether to buy Bitcoin. This is a fact that is not acknowledged very broadly speaking. Okay, I can say it because I know this to be true, right? Whether there are good reports or articles, maybe our viewers can pitch in with some of that information. I know it to be true. Okay, Tether was primarily a money laundry vehicle for people in China to acquire Tether in Hong Kong or in China. That part I don't know. Get the Tether out of China and use that Tether to buy Bitcoin in Hong Kong, presumably.
So
Right?
what that's telling you, Nick, is the dollar matters and Bitcoin matters. And this is from a Chinese private sector. If you're a household, right, you're saying those two things matter. And from a tops down framework, the choice is gold. Like they've sharpened their spears and like armed up on gold, right? But this is going back to what I was talking about earlier. It's three things: there's dollars, Bitcoin, and gold. It's checklist all of the above right now of the tools in play and that matter in this global conflict
And it
from a
doesn't feel
capital
like
wars angle.
a coincidence that the Tether came shortly thereafter
With
this
21.
this Chinese no, I mean,
Oh,
the usage of Tether by China to escape their currency devaluation that was going on during that 2015 era. I mean, that led directly to Tether being used, and it's right after the Shanghai gold contract. So that's my way of explaining to people that these things are intertwined to a
it,
much greater extent than we might
it
think.
was a market response, right? So,
That's right.
so,
So keep
so
going.
to put this in the framework, what we're seeing in the headlines, Liberation Day, get away from the knee jerk analysis and take a view of what these tariffs are from an offshore dollar perspective. And I think you'll get more signal and understanding as from my perspective as a fixed income PM, but every asset class, every investor can benefit from this. So what did the tariffs 2.0 represent starting on April 2nd from a dollar phenomenon? Well, technically what a tariff is doing is it's compartmentalizing trade, right? It's not blocking it. It's not an embargo policy. You can still trade with the United States and get access to dollars. But if you're going to do that, you're now going to have to pay a tariff at the importer level. And then what that does on apples to apples, if you're considering one good, like you're shopping on Amazon for, let's just say children's toys, right, which is 90% plus imported is the way this has gone from a manufacturing standpoint. Now, if you're looking to apples, like from the 10% of U.S. domestic consumption that goes into children's toys every year, you're looking on Amazon, and you may not even have to dive deep and specifically look where was this manufactured. You're going to see it in price, and you're going to see U.S. toy price, and as a supplier, you're a price taker. You're going apples to apples. Now, instead of international production, non-U.S. production, having an advantage of being able to undercut just based on FX arbitrage and labor arbitrage, now the playing field is leveled, and specific countries who the U.S. government deems as most important in the offshore dollar kind of framework get a higher penalty rate, right? But now, if you're the U.S. consumer and you're picking the toy based on all attributes, quality, everything, look, feel, color, etc., all of that, you ultimately get into the most important variable, which is price, which dictates value. And now you're on a playing field that prior to April 2nd, you had the playing field was tilted against you as a domestic producer. Now it's working in your favor, right? So all else aside, you still put the choice in front of the U.S. consumer, the most important consumer in the world. More times than not now, probability weighted, they're going to choose the domestically produced good, right? Which keeps the dollar inside of the U.S. financial system all the way down the value chain, as low as you can go. And like there could be some leakage, right? At some point, there's an input good. Like, are we going to import the wood for the toy from Canada, or I don't know, a wheel axle for an auto from Mexico? Yeah, you can still do that, right? It's not an embargo, but more of the value capture now is going to stay within the U.S. economy. And this is just on theme with another broader shift where the entire value chain you're seeing from each of these regional blocks are trying to keep more and more of the entire value creation at every step in the process of creating a good or service and ultimately delivering it to the final consumer. More and more of that stays within your own economy and financial system, or the right word for this would be mercantilism. Right. So that's how I view the Tariffs 2.0. And what you're doing there is essentially you're cutting off the flows of dollars internationally. So this is based on global trade is the important things. This is where you see Besant in his comments. He'll give you more economic clarity if you listen to Besant than anyone else. He'll put you in the right direction. And the way he talks about this is, creating a shift from Wall Street doing well, right, where stocks can outsource consumption, or large cap equities can keep gaining from this arbitrage, right, and hit all-time highs in profitability. Now more of that share of the value creation. Margins will not be as good with this framework, but value is staying inside the country, which is supposed to ultimately lead to some share of value transfer back to the American worker. But what it nets out to, this is an offshore dollar story, in my opinion. And that's why you see the response from Europe, Russia. Why is everybody so upset on this? The global trade is cutting off the flows of dollars. It's turning the faucet. It's not off, right? But instead of full flow coming out of the sink, it's now a half flow or a quarter flow. And that's what we need to continue to watch, is that offshore dollar diminishing. And so with what we saw in gold, right, the bull market is, all right, China, no, they're all singing to the same tune. They know that state policy is, hey, we're going to store value in gold. We're going to buy. What happens when that dollar flow starts to turn off? Well, about 3 weeks later, you see gold top out, right? And so it's just kind of a natural response that plugs in with the with the, what would you call it, the Bitcoin layer thesis, which includes an offshore dollar framework as part of it. And so how will you know if this is a cyclical top at 3,500? I think keep watching. But what you need is an expanding open interest overall, more action, more volume hitting the Shanghai Futures Exchange. And then you need a long tilt to the financial players. They're coming in to buy long, right? The producers, the other side of the trade, they're not going long. They come to sell their gold into market and produce their P&L, their income statement. So watch those two things. If open interest flattens out, and then the financial firms, the broker dealers start to reduce their long bias, that's a sign that it's time for a retracement in gold, which it has not seen any in the 18 months to 2 years really since it's been on. It's just been up and to the right, on a tear. So a pullback is something you're watching for in gold.
So dumb it down for us. Why does the Liberation Day plus 3 weeks cause the gold or the gold price to top out in China with a slowing of dollar outflow? So China is receiving less dollars 3 weeks later, right? And
yep.
And so, but then the gold price tops out. So what?
Yep.
So why does that happen mechanically?
Yep. So markets don't perfectly process information on a dime, right? They trend until you run into the boundary point. They're efficient, but it takes time for the flows to work through.
Got it.
So with the wily coyote running over the ledge, he stays until he realizes, oh crap, and then he falls. It's the same thing. So Liberation Day comes on, we get a panic from market response, but in terms of the flows, all of your orders, your processing, your freight on board, your actual transfers of dollars, those may still be going, right? Because the time for cargoes to get in and arrive at their destination, that takes 2 to 3 weeks. So the financial flows are still working through the system. They're still settling. There's still dollar flows coming in. It's slowing down. But then what happens? Markets realize it all at once. You top, and then everybody goes, "Oh crap!" And then price reflects.
So what we want to think about from the big picture is bring it back to recycling. The US buys from China, exports dollars. Those dollars are being reinvested, recycled into treasuries. Then China says, we're not going to do that. We're going to not recycle them, but place them into a different system in gold and basically get out of the dollar at the margin,
Yep.
right? At the margin, not selling treasuries, but at the margin, getting out. Then the dollar flows start to slow down in April of 2025. So now there's no boost to that gold demand because the recycling firepower that they were redirecting toward gold is slowing down and has run out. So this is
Yep.
so the gold price topping out in late April of 2025 could simply be a function of the trade policies itself and the slowing of dollars exported and the reshoring or the boosting of, as Dines described it, keeping dollars onshore. Now, my question to you is, if dollars are kept onshore and not sent abroad, does that strengthen the dollar versus DXY? Does it weaken DXY, and why? Can you explain that part to us? Or is it tough to say because there's so many other things going on?
It's very tough to say because there's so much that has to break, and I think I'll get into it, but there's probably 2 to 3 months where we have to see which way certain things go before we can make that call. But if you look at, okay, DXY, everybody's following DXY, right? It's really dollar versus euro and dollar versus pound, dollar versus CAD. The non-US G7 countries are the ones that are strengthening versus the dollar, and that's coming in from policy. Right? We probably don't have full time to get into it. But then if you look at non-G7 countries, look at the BRICS, look at dollar versus the Indonesian rupiah, look at like dollar versus Indian rupee. It's crushing, right? So there's two different systems happening, and which way it goes. You know, U.S. policy is a huge player in which way this breaks. Like I can write a case for it going either way, like a massive dollar. Actually, it's probably a combination of both. You're going to have to see strengthening from the non-US G7 currencies as just what's gone on over the last 2 to 3 months, and then possibly dollar continues to maintain its strength in the offshore dollar market, which means international trade with your key trading partners, which include China, India, Indonesia, South America, etc.
Of
So
course, and we
it's
didn't even
complicated.
mention, we didn't even mention interest rate differentials, so we don't have to get into that. I
Yeah,
think one of the main takeaways here is that the dollar trades versus dozens of important trading partners,
yeah.
and what it's doing versus each one of them is going to be
So
mostly an individual case, or somewhat.
so to take this into the next 2 to 3 months, what we need to watch for and see how things break and which side of the trade wins or is ultimately correct here. You've got kind of three scenarios as this progresses. I think that each kind of macro strategist would subscribe to. I'll break them down in three. It's China head to head with the US, where it's winner take all, and one of them breaks first and wins this great power competition. That's how a lot of people are covering this. I don't subscribe to that. Number two, you can strike a new trade deal and both win win. That may be the long term outcome, but it's not going to happen in 2 months. This is like, that's something that's going to be a massive arrangement. It's a reshaping, it's a renegotiation of the Nixon Kissinger deal with the Mao communists that really ushered in the Deng era with China. You may see a renegotiation successfully come out of that deal and a new trade agreement, just recognition of states, sovereignty, all of that. That's harder. It's longer. That's probably the best outcome possibly for the global system. And then number three is both U.S. and China survive this out in the short term, and I think that's my most likely base case. And it's someone else who bends and breaks first, right? And so you get into that. I think that third case is actually my most likely outcome, where I put the most probability weight for the like through the end of Q2. How do I know this? What am I reading on to inform this? Well, over the last, like this week, the hot trade idea I'm seeing from my large broker dealer counterparties, they're not just trying to sell you something. They need to get you on the right side of the market so that ultimately, as an institutional manager, you make money. But what they're telling me to look at this month is Ukrainian sovereign debt. Why does that matter, right? The peace negotiations in Ukraine, you can see it in the headlines. Those are the key things to watch for the month of May. And there's some hangups there. The bid ask is so far between. I don't know that we can come to a successful peace. When I mean that, a long-term lasting peace, a durable peace that lasts for a century. I don't think we have the ingredients set up for that. But what you can see is if there is some sort of intermediate deal we can find, this will be favorable. From what the broker dealers are communicating on the sell side is that the main beneficiary of that will be the dollar Ukrainian sovereign debt. Now we can do a deep dive on the dollar Ukrainian sovereign debt. This is slide 4 to give the producers some background. So the debt distribution for the Ukraine, the war, the key thing in any war, like once you're in a war, the most important thing is to obviously make sure you have the supplies you need to keep fighting and then ultimately prevail and win. It's a war of attrition and you need to finance it, right? If you run out of capital flows to finance your war, you're done. Game over. And so you look at how this Ukraine war has been funded from the European side perspective, because this is a Russia-European conflict, which if you look back in history, several of those, right? They flare up from time to time as they do. We're in one of those periods again. But it's 57% funded by your G7 coalition, right? When I say G7, US, the Western European democracies, and Japan, right, is providing the capital. And that comes with Canada in there, there's a few others. But when it comes down to it, how is that funded, right? 57 cents of every dollar going into the war is funded by the G7 countries. This is your smoking gun. If you need one data point, that the offshore dollar is still tantamount from a capital wars perspective. Look at how this war is financed from the non-domestic capital base. 2/3 of it is in US dollars, which is primarily offshore dollars. I'll get into that with the regulatory filings. You can see it. But this tells you the depth and balance sheet capacity in all of these other current currencies. The euro in second place, the IMF international drawing rights in third, and then Canadian dollar and Japanese. Like, they're trying to help, but they're not doing anything. You can't actually run the war at that point of contest with those other currencies. You still need the offshore dollar to continue to fund it. And then if you go to slide 5, you see this is what they, Bloomberg considers the on-the-run Ukraine 10-year bond, which was a rollover last August when we got into a refinancing situation in the Ukraine sovereign debt. These are triple Cs. They're high yield. You're not going to see these in your Bloomberg U.S. investment grade aggregate index, right? But where is the financing coming from? It's coming from the sovereigns, right? The U.S. has committed, I want to say, like, there's 24 billion in loans and call it 180 billion, something like that. We can go look up the figures exactly in aid. The loans from the U.S. standpoint, the debt financing is coming at the sovereign level. It's not coming from private balance sheets. Like, it's not in funds. It's very little of it. Maybe 5 cents of every dollar is in emerging market fixed income funds and credit funds that are domiciled in the U.S. It's actually being financed from a dollar perspective from the offshore money centers. So let's say 27 cents of every dollar for this most recent 10-year Ukrainian debt issue is coming. It's in private balance sheets, not sovereigns, as like another pass through, which is ultimately being financed by your big balance sheets, banking sector, pensions, et cetera. It's it's like 80% of this of the private capital, so corporations, individuals, et cetera, is in offshore dollars, which is where all the risk is. So it tells you what's going on in these peace negotiations is all kind of leveraged on the fulcrum of what happens in the dollar still. The dollar still, despite all the de-dollarization narratives, uh, has a highly important seat at the table out of necessity.
And you can literally see Eurodollar as the market in which this bond is issued. What that basically means is that the deal, the printing of the bond, is done in London. And so when people think about the Eurodollar system and where is this currency created? Well, it's exported out of the United States and then it's leveraged up in that offshore world. And so, we're not doing a whole episode today on the Eurodollar, but it is at the center of every conversation. Dines, like I teach fixed income at USC, and every single lecture we talk about repo. It doesn't even matter what we're talking about that day. Repo is involved in every conversation. And more, now that I'm comfortable teaching the Eurodollar, I teach it early and often. And we actually talk about the Eurodollar now in every single lecture.
Absolutely. So if I had to base on what we're seeing on the evidence and facts coming in, EU looks like the first to blink. Right?
Yeah,
They need the financing. They need the funding. They're reliant on the dollar. And the same tariffs 2.0, the same effect we talked about on China with the dollar flows, it's hitting Europe. Like Europe's in the same boat. They don't have the same penalty rates of tariffs, but it's still sizable from their economy, and their dollar faucet has been turned down as well.
What do you think about my theory that in order to access dollar liquidity going forward from the Fed, it will be welcomely issued as long as Treasury collateral is brought to the Fed's window, either in their foreign repo facility or through a system of swap lines? But basically, if you have the collateral, you can get the dollars. What do you think about that?
That's facts, not even controversial whatsoever. So this is what we've shored up since the 2019 repo cycle, when we were at a similar situation, bottoming out of a dollar credit cycle. SOFR has now replaced LIBOR, right? Which means LIBOR's unsecured financing takes place, struck in the city of London. Now, the lender of last resort, like you can still show up at the Fed discount window if you're a member, but like domestically, whatever. But from an international perspective, you now have to come to New York and Chicago on, the futures market is why Chicago is relevant. But you've got to show up and bid SOFR to get your dollar access, which means it's secured overnight financing, right? You have to own the Treasury collateral. So it's step one in this process. It's US's kind of chess move. It's not as big, like it's not as fully locking in for the long-term perspective. Like China's fully committed to gold, pot committed, done. US, this is an intermediate strategic move in my perspective. We do not intend to stay on a purely, fiat standard, credit money standard, all that, and onto infinity, right? And just see national debt go up exponentially, forever. That's not the strategy from my point of view. But yeah, exactly what you're talking about. SOFR is the key tell right there, and what's allowed as collateral in the SOFR market. They want to see Treasury debt.
Do you think? Do you think that the shift toward labor from capital is a good way to describe the events that you're talking about? Profit margins being challenged in this new environment in which you can't be reliant on the labor and FX arbitrage. And by the way, if we were really being intellectually honest, we would bleep out both mentions of arbitrage when you said labor and FX and replace it with manipulation or dumping.
Yeah.
But answer the question, Dines, about labor and capital, and maybe if you can even give people an econ 101 on what that even means and that the history of that debate in economics?
Yeah, so we got a hard stop at the hour, so we can't do that. Show 2, I'll come in with that. But talking about labor, right? Why do we need why does labor matter now? Go back to that compartmentalization, more dollar flows staying inside the US domestic economy. All else equal, part of that flywheel means the US worker, the household, and then small, medium business all the way up are favored now in terms of access to dollar flows. That's building up their balance sheets, which is part of the financing problem or solution to the financing problem. How does the nation state fund itself? Now, to do this, all right, I think you have to go into speculation a little bit. My view is we need higher interest rates, right? Just where things are. And I don't mean that in the short term. In the short term, we're getting cuts, right? 75, 100, maybe more basis points in cuts, probably starting in June, right, on the short term. But in the longer term, I think you need secularly higher interest rates. Now, to do that, if you just run up higher rates on a high debt burden, those interest outlays, if it's all internationally funded and you're selling the debt to the global dollar money centers, they're just going to exponentially build up more and more of your dollars. And then from that, it's a weapon against your nation state. Now they can speculatively attack you, take over, and like it turns into what's it called? Like a disadvantage on the international conflict scene. If you compartmentalize and you can keep the dollar flows within your domestic system and you're encouraging the build up, the balance sheet expansion in the private sector in your domestic economy, and you have to pay higher rates, it is technically good for your domestic economy. It's not good. It's ultimately good for your currency, but it's not good for the IOUs in that currency. So you're looking at, this is where you see like the Latin Americanization of US dollar capital markets. I think we're in a position where that's where we have to be, right? Now, to bring it back, also the comment on EU and how the steady state playing out. EU is giving you signals on what their strategy is, and they're telling you, like they're communicating that they're in a sense of desperation, right? They've stated that they're going to launch the CBDC, or they intend to launch the CBDC in October. They're going to launch the Savings and Investment Union to leverage their private sector savings, their bank deposits, to fund the sovereign, right? That's how they're going to fund the nation state to continue the war of attrition. The European Commission has warned its citizens to stockpile days of critical supplies, which makes what happened this week in Spain, in particular, interesting in a very timely manner. And then, in my point of view, you're in the riskiest situation. Like this looks like you're throwing for it on 4th and 30 with 10 seconds left on the clock for the Hail Mary, right? You're not testing your system. You're going on all these steps to transform your monetary system on unproven technologies that aren't selected by market competitive forces. And this seems like as bullish as people like the euro is appreciating, as we talked about FX, a question 20 minutes ago, where do you see the dollar going against like DXY? Well, euro is the biggest component of DXY, and it looks strong in the short term, right? Because EU is fully pot committed. They want to continue this war in the long run. They're rearming. You've got German troops and like where Estonia right now, they want to keep taking this. Like they are not ready to settle for an intermediate peace. The fact that you're throwing, those type of like desperation moves out there is high signal in my perspective. So yeah, euro may appreciate for now, but like on a short term timescale. But I still don't know which way DXY breaks on the major kind of breakout versus the upward trend we've been in since post 2008.
Do you have time for money and promises, or you have to hop?
Let's do it. No, yeah. I think close it out with Money and Promises. Probably my second favorite book I've read this year, next to Bitcoin Age, of course. But Money and Promises goes through 7 case studies. And I think a key one for understanding what we're going through right now is in a particular chapter on the British system. And you get the crossover story from an old kind of proto money like a medieval era money, which was tally sticks. And there's a picture of them on slide 6. What these things are, they're basically a ledger money, if you will. And it's kind of the equivalent of the bond itself. It's the public debt for tax revenue collection. This was the British monetary system up until you saw the crown get into a sovereign funding crisis with the 9 Years' War, 1688 to 1697. There's all kinds of things going on in British history in this era. You've got like the Cromwell era, all of that huge era of upheaval. And then you've also got a global conflict. You've got UK versus like a European coalition versus the France crown. And then it's like the war is taking place in India, other jurisdictions. So it's kind of viewed as the first global war, like a global conflict, before we start calling these things World War I, World War II, etc. And so what you saw in this era, right, the most important thing, as I've highlighted, is the nation state, or a society, a collective group operating together, kind of everybody rowing in the same direction, how you define a nation state, organized, cooperating, all of that. The most important thing when these different groups come into conflict is to stay funded, stay capitalized. And this is an era where a monetary transition can and very likely does happen in historical case studies. And the key one is, this is where the Bank of England came into existence. And it wasn't, as the Bitcoin age gets into, it wasn't due to a financial group looking to protect themselves with a state-funded bailout mechanism, as you get into in the Bitcoin age, which was how the Federal Reserve was kind of brought into existence. It was funded as kind of a startup project where gold bullion traders, public debt market traders, and the traders in these tally sticks were all highly profitable. It was the state that was under the 8 ball, and you saw annual expenditures for this war effort ramp up from £2 million a year to £6 million a year, which is right at the ballpark we're at. On the chart, I pulled the Fed Treasury outlays. It's about where we are on trillions of dollars. Just get rid of the pounds, change your order of magnitude from millions to trillions, and flip pounds for dollars, and you're at a similar spot for the nation state in the U.S. This is an era where, all right, William Patterson goes to Parliament, says, I want to get this, I don't even remember if they called it the Bank of England at startup, but start this new capital group. They raise equity from the landed gentry, the king himself, all of these participants. It wasn't necessarily banks from the get-go, to create this entity where you would aggregate hard money, so gold bullion as 60% of the capital, and then soft money, credit, tally sticks, etc., as another slice of the capital. And the whole purpose of this existence was to fund Parliament, like transfer Parliament's IOUs, the Crown's IOUs, for bank money. And why does that need to exist? Well, it's to maximize the purchasing power of the public debt to get the goods and services it needs to accomplish its objectives, which in a time of war, those objectives are crystal clear. It's win and prevail, survive, right? And so what we're seeing in the headlines here, like obviously you're seeing from a legacy system, all of the other frameworks are struggling to keep the state funded. This is where the startup can come in and outcompete. And this is something to continue to watch. But since Bitcoin's emergence and acceptance as a hard commodity money that's purely electronic, it's weightless, all of that, all of those valuable properties, it's established itself. But now you're starting to see those entities pop up with the Strategic Bitcoin Reserve, the private sector capitalization entities like 21, following on Strategy, that look a lot like kind of the equity funding initiatives like the South Sea Company that you saw in this era in Britain, and then Treasury adoption, a Secretary of the Treasury who is friendly to Bitcoin, a Secretary of Commerce who is friendly to Bitcoin, executive branch who is entirely open to this now, instead of taking an adversarial take. You've now got all the seeds planted for Bitcoin to fulfill its role as money, to meet that key objective of keeping the state funded. And if it works for the state, it doesn't matter. It's going to emerge via market forces. What does the best job at accomplishing that goal? Because you're not in that position of luxury where you get to pick winners. Say, no, it's gold only. Sorry, Bitcoin, or it's credit money only, or treasuries only. You're in a position of need, not privilege, to choose winners and losers. So it's going to be market forces that dictate the emergence, right? So I think that's what I leave us today. Like, keep watching, but Bitcoin is very quietly under the scenes in a first, like since going on a rally Q4 of last year after the Trump election victory and Republican sweep of both Congress and the Senate. You've seen that retracement, right? But in the background, you've seen all these new entities start popping up, and the details, the wires are getting plugged in. And as this funding need becomes more and more pressing for the Treasury, we'll get some relief, like on the front end rate. Like, there will, in my expectations, be further rate cuts on the front end for short-term and overnight funding to add some relief in the system. We'll get a rally in bond prices. Talk about the Ukraine offshore dollar debt, which is also ultimately, going to translate into Treasury curve movements, and expect some rallying there. But I don't think it's large enough and at scale to get the United States funded through this broader war. And I think we're at that point to call it that, and not sound like we're going out on a limb. And I don't think we're near a lasting peace, like anywhere near, because we've already been communicated to what each regional power wants to see come into its sovereign kind of control to be happy with a lasting agreement. So both the EU plus UK and then Russia on the other side, they've established their conflict ground. It starts with Ukraine, right? And you're at a stalemate there. US has already communicated what it wants, reaffirmed, because Trump has said these things in his first term, Greenland and Panama, and a return to the Monroe Doctrine. Why? Because of trade flows, right? It's shipping routes, which is ultimately, translates on the mirror image of that is capital flows to finance trade. And then China, among other things, Belt and Road, all the above, they want to be recognized as sovereign over, what we call Taiwan, they call China, right? So until we get all of these things kind of cash settled, I don't think there's an intermediate or a lasting peace, which tells you the funding need is going to be a pressing issue once we get outside of these initial moves, which we should get the short-term clarity, I'd say, by June, and then longer term, the big picture developments in Bitcoin, gold, dollar will continue to trend in their overall directions that have been established since 2008, really.
Combining the Bitcoin market, the bond market, foreign exchange, global commodities, global macro, financial history. There are a few that do it like Matt Dines. Thank you for joining us once again at the Bitcoin Layer. Please tell people where they can follow you.
Yep. Follow me on X at Levered USTs is the best place to reach me. And then for those in the audience who will be traveling to the Bitcoin conference coming up at the end of May, I'll be there as well. So DM me, open to private meetings, and that's how we can get in touch.
Excellent. Matt Dines. I'm Nick Bhatia. We'll catch you guys next time.
Thank you.